Now, let's talk about the Forex market, basically the currencies market, okay? Just so you understand, currencies react to both economic conditions and global risk sentiment. And during uncertain times, we often see movements towards stronger or safer currencies. But at the same time, currencies linked to commodities like, for example, Canadian dollar, they link to oil, they also react. So what we've seen over the last 2 weeks is the shift in the market positioning, and investors are adjusting based on risk, and this creates movements across multiple currency pairs. And now again, the same principle applies when markets move in cycle, right? So what is strong today may weaken tomorrow, and what is weak today may strengthen tomorrow. And so the goal is not to chase the move right now. The goal is to understand what is the cycle. Okay, and that's exactly what we're going to do now. We're going to observe the top global, let's say, currency pairs in order for you to understand where they sit since the conflict started and where they may go should the conflict stop. Okay, so let's move to my screen, and we're going to take and we're going to look here. So we're going to start with the Euro US dollar. Okay, you can see here Euro US dollar. I'm putting the graph specifically on one daily graph. So every candle now here represents 1 day movement. That will be easier for us to reflect on the movement in total. So I'm gonna bring the mouse on the beginning. Here we go. You see, at the beginning of the conflict, the price, the exchange rate between euro and US dollar, because that's the euro US dollar currency pair. So the exchange rate was at 1.18. You can see that here, 1.18, that was the exchange rate just the day before the conflict started. And since then, you may see that the euro fell down day by day. This is 2nd of March, 3rd of March, and basically going down, 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 up until it dropped down to 1.14. So imagine the difference between 1.18 and 14, that's 400 pips. That's the huge distance that the market gone down for the last, like, what, 1.5 week. Okay, since it gone down to 114, it came back to 115. So it's recovered by almost 150 pips back. Now, what is that 400 pips? Just so you understand, when you do your trading, that pip value could be different. It could be $1, it could be $10, it could be $100, depending, of course, on your trade size. So imagine if your pip value is just $10 and the market gone down by 400 pips, we're talking about $4,000, right? That you could actually have made if you would be just trading one lot trade size. Now, with the leverage 1 to 200, that would just require from you about, like, what, $500.